Good morning, everybody. My guest this morning is Luke Beatty. He serves as the chairman and CEO of Brandfolder, a digital asset management platform located in Denver. Prior to that, he served as the president of media brands at Verizon/AOL. He founded Associate Content in 2004 and served as its president and CEO and sold that company to Yahoo in 2010. Before that, he served on the executive management team at Wand Inc. His expertise is in contextual advertising models, online media collection, and distribution strategies. In his free time, Luke is a youth lacrosse coach and fly fishes around the world. Luke, are you ready to take us to the top?
Yeah, let's do it.
All right. So tell us what Brandfolder does and what's your revenue model? How do you make money?
Yeah, so it's a very traditional SaaS model, and it's a platform that allows brands to manage their digital assets and track the behavior and analyze the use of their digital assets across the web.
And what kind of space are you playing in? Enterprise, small business, mid-market?
Enterprise, and we do some mid-market, but most of our customers, we have about 4,000 customers, and I would say more than half of them are brands that you know and you use on a daily basis.
And can you give us a general sense of size? I mean, are these people paying $100 a month, 10 grand a month, $1 million a month?
Yeah. The average, our range for the down market product for the sort of medium-sized enterprise, you're looking at brands that pay $5,000 a year, and then we have a lot of brands that pay up to $150,000 a year for a very tricked out enterprise level product.
But you would say average is maybe in the 5 to 10K range annually?
A little bit north of that, yeah.
Okay, fair enough. And give us more of the backstory here. So you sold was it your first company in 2014 to Yahoo, or was that not your first?
Yeah, that was the first company that I started, yeah. And we started that in 2004, kind of did a traditional kind of Silicon Valley, Sand Hill Road kind of angel round with Ron Conway kind of standard deal, and then raised.
Well, not so standard anymore. I bet terms were a little different back then, huh?
Yeah, terms were different, and so was due diligence.
Did notes exist back then?
There were no. I mean, I think they did, but they definitely weren't thrown around the way they are today. Although I think that's also starting to the sun's setting on a little bit of those sort of open note raises.
You mean uncapped?
And then raised a couple rounds of financing from SoftBank, and then we sold that company to Yahoo in 2010. And I stayed there for a while. And I actually started Brandfolder while I was working at Yahoo and really spending a lot of time at the company that acquired my company, and really, along with a couple other folks, came up with the need for Brandfolder. So I sort of started Brandfolder from an idea perspective and came up with the product plan.
And what year was that, Luke?
Found people to build it. 2000. Let's see. We started. Brandfolder's been around for about 5.5 years, I think, from like an incorporated level.
So 2012.
Yeah, and so we started that company by just putting the money together and finding some engineers in town to start building it. It wasn't necessarily, hey, let's have a startup and let's do that. I needed the product at Yahoo. My friend Chris Gloday needed that product at his company, as did a lot of other people. So
how did you carve out the IP so that there weren't any conflicts with Yahoo when you did obviously go all in?
Yeah. When you join a big company like Yahoo, you have to sort of very clearly detail what you're working on and what boards you're on and where your investments are. I think brand management and SaaS sort of platforms, I don't think have really raised a flag at Yahoo at that time. Obviously, their model was really content and ads. So
I mean, but what did that actually happen? I mean, so you're working, you and your friend need it, you scrape together some stuff, you build it. At what point do you go, wow, this thing has escape velocity, I should quit Yahoo and go all in?
Well, it took a while. I mean, we sort of played around with it. I didn't quit. I actually had another job in between, which was running the media brands for AOL and Verizon, which was very similar to my job at Yahoo. So, so I didn't start working as the CEO and joining Steve and the Brandfolder team until about 7 months ago. And until before that, I had been really just the board chair and really sitting on the board and participating in from an investor and board perspective. So I think the indication of velocity was more around just, I'd never seen a company that had built such a clean and clean and clear and concise product that fit a very perfect niche with such an incredible customer base. I think, it was also a company that was, after, tooling around for 3 and 4 years and really trying to find its product market fit, had gotten to cash flow positive and really was a great thing. And I felt like, hey, I can come in, raise a quick round of financing, and we can grow this thing into a.
How much total has been raised?
Our early stage kind of Techstars, angel stuff, I think amounted to about 1.5, and then I just raised around a little bit north of $5 million.
Okay, so call 6.5 in altogether. And now,
I think we're probably close to 7.
Okay, did you participate in that first $1.5 million round back in the day?
I put the first money into the company.
Yeah.
Me and other people. Yeah, not by myself.
Yeah, good. And you used it as a customer, which is a great place to start. And you kind of stayed attuned over the years as you're, collecting more information from all these different brands you're at. Now you go all in full time.
Yeah, and I spent my weekends and stuff working with these guys on it.
Okay.
And it's been a real pet project for me. I think it's funny. My background has been almost exclusively in media and in ads and content on the big side, running brands like TechCrunch to Yahoo brands like Yahoo Autos and big consumer facing media brands. And so which is a very, very difficult business. So the prospect of working on a SaaS business that I felt like had
predictable revenue.
Predictable revenue, or just what I like to call revenue,
or revenue at all. Yeah.
So that's been how that's worked. So
Luke,
it's been good.
What's your team size today?
We have 25 people,
Okay.
mostly in Colorado, except for like outside sales folks in region.
Okay. And what do you spend? I mean, 4,000 customers, that's nothing to shake a stick at there. How are you acquiring these guys? What are you paying, all in to acquire a customer?
It just really depends on the product. I think, for a big enterprise customer like a JetBlue or a one of the sort of bigger Under Armour, kind of some of our bigger, huge accounts that we have, we will pay, like most SaaS companies, we try to have a 12-month payback. So we're willing to invest 12 months.
Are you at that now across all your cohorts, about a 12-month payback?
Try to be, yeah. Okay. It kind of really depends on the product. We also have a lighter product that isn't necessarily for smaller businesses. In fact, a lot of our biggest businesses, like a Slack or something, they don't have our biggest offering. So it's really not about that. It's more about use case as opposed to company size. So those guys. A lot of those guys come organically, and then their payback is very, very short. I think some of our directly sold enterprise stuff where, we get guys into market, we do a lot of demos, we show them, we do some sales, we do a lot of training, and, it's a heavy onboarding. Some of these brands, are uploading digital asset libraries of, tens of thousands of images, especially e-commerce people who, most companies have logos, GIFs, colors, fonts, and a really important set of brand assets that are kind of common, whether you were a landscaping company or Facebook. And then there's other companies that work in e-commerce and stuff where you imagine, a company.
Oh, the product photos.
Product assets. That's
so
crazy.
Before we get too far away from payback, I mean, you mentioned earlier your average contract value there is about 10 grand. So it's fair to, and you're getting paid back in 12 months. So it's fair to say you're spending less than 10 grand to acquire these guys, at least your core cohort.
Probably not the cohort, but our top cohort, our most expensive enterprise cohort. Yeah. Okay. I mean, the averages get crazy over a period of time where you have to really do it by what kind of Brandfolder people are buying.
What do you look at when you look at either churn or retention annually? Where are you guys at today?
We try to be north of 90%.
Okay. In terms of revenue and customer and logo churn?
Yeah. Yeah, both net and gross.
Net and gross. Okay, so just to be clear, gross logo churn annually is less than 10%, or said otherwise, retention is higher than 90%. In terms of gross revenue retention, you're also above 90%. Now, are you at net negative revenue churn?
We are probably at net negative retention churn, certainly on our big enterprise customers.
Yeah, where basically your expansion.
They'll do add-ons and add new features, and that's pretty common. So I think we're unusually unusually good at managing our retention and our churn. I think.
Is that predictable, Luke?
I think it's been that way since day one. I predict a dip at some point once we get to a certain number. I mean, I think if you look at, you look at a lot of research, it's very hard to get at a massive SaaS scale and try to keep that north of 83 to 85% of gross logo churn. Right. So just number of accounts.
Yeah, but most people, once they're your scale, they stop looking at logo churn and they care way more about revenue churn, like net revenue, because
I'm in the logo business.
Well, yeah, but it doesn't matter because you have vastly different price points. So you don't care about losing $1,000 a month customer. You care about losing JetBlue, right? You can afford to lose 100 small customers,
I think we care about both. We manage both. Both are in our goals that we track on a daily, monthly basis that are on the wall directly across from me right now. So we look at both churn numbers. But in any case, I think it's very hard to keep them as high as they are right now. I mean, we'll obviously keep doing it. And, we have the best customer experience team. Our product compared to most of our competitors is a very premium white glove customer experience team.
Yeah, look, I agree with you in terms of logo churn. It's hard to keep high as you get higher volume, but revenue churn should be
retention. You should be able to grow it.
Yeah, I was going to say revenue retention. You should be going much better over time. Yeah. Interesting. Now, is it predictable?
We do a lot of consumer. Sorry to interrupt you. We do a lot of consumer brands, and as you know, consumer brands come and go with the wind, right? I mean, they get bought, they get sold.
Do you have pretty predictable expansion though? Like from year 1 to year 2, like do you know that account on average is going to grow 130%, 150% based on upsells, or is that not yet predictable?
Once we get into cohorts, we do.
Okay, interesting. All right, good. And then last question here before we wrap up with the famous 5. What do you assume lifetime value is on these guys? How do you use lifetime value to help you kind of guide other parts of the business?
We try to think of about a 10-year customer, your 10-year SaaS magic customer. I mean, I think that's really where we are with our retention rates and our ability to hold on to folks. That's where we exist. So I think that's not out of the question. I would say now at the board level, we think about that in a very thoughtful way. I think we have work to do on add-ons and adding, new features to folks. I think lots of times we try not to, interfere with brands' use cases. I think, we have, you take a good segment of ours like pro sports. Most of the pro sports teams, as you can imagine, are loading in all of their logos, all their player images, all of the art that they're using in the stadium, all that sort of stuff. But there are random edge cases that teams have where they're not even doing that, which is the most common thing you would do with a Brandfolder. They're doing it in a different segment. So we have to really start engaging on moving people out to edge cases and into core use cases so that they can get the product better. We haven't spent a lot of time on that. Our business operates 100% on inbound sales right now. So we need to get better at going out and especially to existing customers and moving them into new features and building.
And then in terms of size-wise, before we close out here, you mentioned 4,000 customers, $10,000 a year is basically, what is that, $830 a month? So it's fair to say you guys are doing north of 3.2 million per month in revenue?
No, because all those are different sizes. A lot of those when we first started the company, we have probably, about 700 to 800 big time paying customers, enterprise customers. The balance of those in the 4,000 number are a lot of early stage customers. When Brandfolder first started, you could buy a Brandfolder with a credit card online for very cheap. And
got it. So you're doing less than 3.1 a month.
Sure.
Yeah. So it said otherwise, your average kind of customer across your even historical cohort, they're paying less than that $10,000 annual ACV.
Yeah. Although we haven't sold those Brandfolders for years. We're actually getting ready to launch a product that's going to be able to be bought with a credit card here soon. But for the last 2 years, you haven't been able to buy that product.
Got it.
But we've retained those customers.
That's good. I mean, that's good. They're sticky. What are you doing above? Have you broke $1 million a month?
I don't want to discuss revenue right now.
Well, you hit it. You got 30 days left in the year. Will you break it this year?
Well, we will double in revenue like we have every year since we started. That's the revenue number, I'll tell you.
That's good. All right, fair enough. Let's wrap up here, Luke, with the famous 5. Number 1, what's your favorite business book?
My favorite business book. My favorite business book right now, which I just read about a month and a half ago, is Zingerman's, which is a deli in Ann Arbor, Michigan, which is a very famous deli. And if you haven't been there, you should check it out. It's kind of got a cult following in a college town. And they wrote a customer service book that is really amazing. It's a very quick, short read, and it details how a bricks and mortar business has a very unconventional customer service model. And I'll say that the punchline for the book for me is that if you go into customer service with an expectation that it's like fair, you're screwed, right? The way you have to work it is, this is an unfair thing. I'm going to be giving way more than I'm getting. People are going to be unreasonable. They're going to have unreasonable expectations, and you need to meet those. So the book is just called Zingerman's, which is the name of the deli, and it's a really good book about customer experience.
Number 2, is there a CEO you're following or studying right now?
I always follow Sheryl Sandberg.
Okay.
I think she's really I've spent some time with her, and I obviously follow her like anybody else that works in digital. I think she's the most versatile person. She's unbelievable. Talk about as somebody who is in a complicated cultural situation, somebody who has had enormous personal challenges. Talk about somebody that has really done B2B and B2C stuff. I think she's just a real glow in the dark person who I watch at every turn.
Besides your own, what's your favorite online tool?
I think my favorite online tool is Zwift on the consumer Swift.
Yeah, that's what it's that's the bike, right?
Yeah, I'm a bike rider and somebody who likes to be in bike races, and Zwift is a venture-backed startup that has built a very, very complex virtual riding experience for training, racing, and all that sort of stuff. And if you haven't, you don't have to be a cyclist to check it out. The complexity of that product. I always tell people, when they go, we can't build this or we can't build that, or that'd be so hard. I'm always like, go home and look at Zwift and then come back and tell me that you can't build that product.
You guys can go look up. They did over $30 million in 2016 revenue, growing really fast, raised $45 million. They just passed 300,000 customers, $10 ARPU. We had the Zwift CEO, Eric Min, on a couple episodes ago. So check that out.
Yeah, that's awesome.
Yeah. Last few here. What's your current, how many hours of sleep, Luke, are you getting every night?
I get 8 hours of sleep.
Okay.
I'm right down the middle on that.
And what's your situation? Married, single, you have kids?
I'm married with 2 little guys.
All right.
6-year-old and 8-year-old.
Wow. And how old are you?
I'm 47.
Last question. Take us back 27 years. What do you wish your 20-year-old self knew?
I wish that my 20-year-old self knew that that while hustle matters and the expectation is that you're working your ass off, you need to set goals around what constitutes success. And you could be hustling, you could not be hustling. That actually matters more, and that's not a 4-hour work week comment. That's just more of the expectation is, especially if you're working at a startup, that you're working obscene hours and hustling and going crazy. But the reality is, if you don't know what constitutes success and you don't have very clear objectives that are recitable by everybody on your team and everybody around, then you're gonna really struggle. And I think when I was 27 years ago, I spent a lot of time just like thinking that if I just ran hard and hustled and took a lot of meetings and whatever, that would constitute success. And that's not the case.
There you guys have it from Luke. Hustle is important, but don't kill yourself. Pace yourself. Be smart about what success means to you. He's had many successes in the past. His current company, Brandfolder, really launched in 2012. He just joined about 7-8 months ago at the beginning here of 2017, bringing in an additional round of capital. They've raised about $6.5 million to date. They've passed 4,000 customers, doing well north of $500,000 per month, but we'll say under $1 million a month. Healthy unit economics, retaining over 90% of their customers on both a logo and revenue basis each year currently, with their team of 25 people out there in Boulder, Colorado, again, helping brands manage their digital assets. Luke, thank you for taking us to the top.
Yeah. Hey, real quick, people can email me at Luke, luke.beatty@brandfolder.com, and I'll set them up with a brand folder to try.
We'll stick that in the show notes for sure. Thanks again, Luke.
Appreciate it. Bye.